In this short lesson, we're going to discuss the internal control systems in a small business environment. Small businesses generally have fewer employees and less resources to dedicate to internal controls. This often causes segregation of duties issues. Policies are commonly undocumented, authorization is dispersed, and owners and managers can easily override the controls. The control environment is heavily dependent upon the attitudes of the owner-manager, and it's not uncommon to find that the small businesses have very informal methods of managing their control risk, and the owner-manager may place greater reliance on the auditor than perhaps warranted as a form of control. Typically, small businesses will use standard accounting software, alleviating the concern over access to code. But offsetting that may be a weak general computer control environment from such practices as sharing passwords or informal backup policies. The key control in the small business is the owner-manager themselves. Generally, if this individual is active in the business, then it's likely that they have a full knowledge of everything that goes on in the company. However, from an audit perspective, it's difficult to place any reliance on the internal controls in this sort of environment, which inevitably leads to a more substantive-based audit. Many small businesses don't require an audit, even if they have borrowing arrangements with lenders. Banks will commonly accept review engagements for loans that are less than $1 million. A review engagement provides a moderate level of assurance. Where an audit opinion states that the financial statements fairly present the company's results of operations, a review opinion states that nothing has come to the public accountant's attention to suggest that the financial statements are not fairly presented. Note the difference. A review opinion is less costly because the public accountant does less assurance work. Review engagement procedures are limited to inquiries and discussions with the client, and analytical procedures to ensure that the information presented is plausible. Only when something looks odd or unusual will the public accountant make further investigations. Another important difference with a review engagement is that the public accountant will spend no time looking at the system of internal controls. For a small business with limited or no stakeholders other than the owner-manager, who still requires a public accountant to prepare the financial statements for them, a compilation engagement may be applicable. In a compilation engagement, the public accountant expresses no assurance whatsoever about the numbers and disclaims this through what is called a notice to reader report. However, because the public accountant is still associated with the financial statements by virtue of their disclaimer, their responsibility is to simply ensure that they are not associated with any knowingly false or misleading information. A compilation might be sufficient for, say, filing a tax return. So I'll leave it there for now, and until next time, don't stop till you get to the top, and when you get to the top, don't stop.